members of the Bank of England's Monetary Policy Committee have agreed on keeping UK interest rates at historic lows at this month's meeting, according to the minutes of the April meeting released this morning. Looking at this data further, I'm joined by UK economist with Capital Economics, Paul Hollingsworth. So Paul, minutes from the April MPC meeting out this morning showed that officials voted unanimously to keep rates steady at a record low 0.5%. What was your immediate reaction from this data?
I think it was fairly unsurprising that the MPC unanimously voted to keep rates on hold this month. Inflation's at zero, and there are plenty of uncertainties, both domestic and external, which justify taking a kind of wait-and-see approach at the moment. I think there were a few interesting points to take away from the minutes. The first is that all members agreed that it was more likely than not that bank rate would rise over the next 3 years, and that suggests that Andy Haldane has sort of backtracked from his view that he expressed between the March and April meetings that a rate cut was just as likely as a rate rise. And the second key point, which I think is worth mentioning, is that two members thought that the decision to leave rates on hold this month was again finely balanced, hinting that Martin Wheel and Ian McCafferty may be close to restoring their votes for a rate hike. I think markets have clearly taken the sort of set of minutes to be a bit more hawkish than expected, with sterling climbing after the release of the minutes, and I think that's probably the right message to take.
Now, you mentioned uncertainties. Bank of England policymakers are more upbeat about the outlook for the Eurozone and see a greater chance that inflation could recover strongly next year. Surely Greece's financial woes and weak UK wages pose a threat to this optimistic outlook?
I think there are certainly threats to the inflation outlook, but I think the MPC's optimism does appear justified at the moment. First, on the wages point, I think wage growth has continued to be weak, but the latest data has been distorted a little bit by bonus timing effects. If you look at the single-month estimates of regular pay, that is stripping out bonuses, they've been a little bit more upbeat. And also survey measures of pay remain consistent with a further pickup in wage growth over the coming months. You have to remember that the labour market has tightened significantly over the past couple of years. So although wage growth has been weak thus far, there is a good reason to think that it should build over the rest of the year. Secondly, on Greece, this is definitely one of the sort of biggest risks to the outlook at the moment. Admittedly, the UK's direct exposure to the country is small, but the indirect effects due to a sort of heightened period of instability in the region and possibly a deterioration in growth prospects would definitely weigh on the outlook for the UK. But I think that sort of underlines why the MPC is likely to just hold off from raising rates this year until they have a clearer view of what's going to happen. They've got to balance these two things. They've got this uncertain outlook for what is going to happen with Greece, but also, on the other hand, you've got some stronger economic data for the Eurozone as a whole. So they've got to try and balance those two things. So I think it just underlines a sort of wait-and-see approach that we're likely to see for the most of this year.
Next week, we'll be seeing the release of UK GDP growth rate. What do you think we'll be seeing from this release?
So the official data so far has been fairly weak, with output in the industrial, construction and services sectors all falling outright in January, and then fairly weak data on construction and production in February as well. So sort of taken together, the official data suggests that we might see GDP growth slow from around from 0.6% in Q4 to around 0.4% in Q1. But then on the other hand, the surveys have actually strengthened. So if you look at the SIPS PMIs, they point to more robust GDP growth of around 0.8%. We'd be inclined to kind of go with the surveys at the moment. So after all, the official figures are frequently revised, and over the past couple of years, there's been a sort of tendency for that revision to be upwards rather than down. And there are good reasons to think that the economy is gaining pace at the moment. The economy is receiving a huge boost from lower oil prices, cheaper credit, slightly stronger pay growth, low unemployment, and high consumer confidence. So there are good reasons to think that GDP growth should be strengthening. So we sort of think that growth of around 0.7 or 0.8% in the first quarter is likely.
Paul Hollingsworth from Capital Economics joined me there. That's all from me for now. Thanks for tuning in, and be sure to keep clicking back to Dukascopy TV for exclusive interviews just like this.